Good afternoon, everyone. I'm Bridget Polachine, the CEO of the IIB, and I'd like to thank you all for joining us today for what is going to be an interesting and practical briefing on what to expect as we enter a new administration and a new Congress. Walking us through the discussion will be 5 experts from FTI Consulting, a valued associate professional member of the IIB. We really have quite a lineup here today. Cheyenne Hopkins, a former Treasury Department and regulatory reporter. Erica Richardson, former CFTC and Congressional leadership staff. Meredith Shalaba, former CFTC Communications, Department of Labor Policy and House Education and Labor Committee staff. Kyle Cormley, former Budget Committee staff and tax aide to a Ways and Means Committee member. Sanjay Marwaha, an expert in FBOs and a member of FTI's leadership teams for digital banking and cryptocurrencies, certainly a hot topic. So as always, we want this to be interactive, as tailored to your concerns as possible, and give you a chance to really take advantage of having this kind of expertise and experience here with us today. So please use the Q&A function in Zoom. If you're on the phone, feel free to shoot me or Megan or info@IIB a question, and we can relay it on your behalf. With that, we will turn it over. I think I'm kicking it over to you, Cheyenne, and thank you so much for being here.
Thank you, Bridget. Thank you so much for this opportunity. So we want to welcome you all. It's a great time of change in Washington, and I'm sure it's impacting your businesses as well as many others. And we at FTI and have a strong background in advising financial firms that are going through regulatory, legislative, or reputational issues in Washington. We have FTI has a global practice, so we have an office in most of your home countries, and we work often, some with your home countries, but here in DC, we help position you well before public affairs. And I will go to tell a little bit more of our practice with Erica Richardson, who leads our financial services public affairs practice here.
Thanks so much, Cheyenne, and thanks for everybody for joining us today. As you can see, we advise across global markets in the areas of corporate finance, economic consulting, forensic litigation, strategic communications, and technology. I think if we go to the next slide, we can give an overview of the agenda and the key issues that we'll discuss today. We'll talk a little bit about Biden administration priorities and COVID recovery. We'll give our insights for foreign banking organizations. We'll talk about key issues in the Biden administration, as you see below. We've got COVID recovery, a mixed outlook for banks, insights about the SEC and CFTC, climate risk and diversity and inclusion, tax policy, international cooperation and tensions, mergers and the rise of fintech, and infrastructure. We'll end the presentation talking a little bit about key appointments that we're anticipating seeing in the Biden administration, and then we will give our perspective on our practice, financial services, public affairs. Please do jump in and ask questions during this discussion and during the presentation. We certainly want it to be interactive, as Bridget said. So we're really thrilled to be here. I'll kick this off by turning it over to Meredith to talk about Biden administration priorities and COVID recovery.
Thanks, Erica, and thanks to the IIB for having us here today. We're thrilled to be able to present to you and share with you our knowledge and provide some value for you as you're planning for a Biden administration. As Erica said, I'm going to be talking a lot about the Biden administration priorities, which of course, number one thing here is COVID recovery, as you can imagine. President Biden on the campaign trail talked a lot about 4 main areas, one being COVID relief, another climate change, racial equity, and economic recovery. We've certainly seen a lot of those themes in the executive orders. I think we're looking at over 40 at this point now, with the president also issuing 15 on his first day and 24 on his first 10 days, which I think might be a record in recent history. So clearly, this administration is off to the races, pushing forward on all of their important priorities. The hot thing at the moment is this concept of pushing another stimulus bill. The president has put out a $1.9 trillion proposal, and you may have seen the news yesterday with a group of Republican senators with their proposal of, I believe, $600 billion over at the White House, trying to hash out some issues and sort of come to a middle ground. So at the end of the day, that this does end up being a bipartisan effort. However, there are some tools that we'll get into a little bit later, budget reconciliation being one of them, that could certainly be the vehicle to pass this stimulus without Republican support. And we know that, you know, the president has felt very strongly about being more bipartisan, about coming together, and certainly on this issue, we expect there to be, of course, elements of recovery, and on top of that, some democratic sweeteners, such as raising the minimum wage and other things, childcare tax credits, things of that nature, that could, of course, cause some issues on the other side to not be included. One of the other elements we wanted to talk to you is, now that the Democrats have a narrow majority in the Senate, there is the option to use the Congressional Review Act. This was not possible prior to a few weeks ago, when we didn't know who was going to win the Georgia Senate races. But certainly the CRA is a tool that could allow Congress to overturn regulations that were passed in the previous administration. And certainly it's something, you know, I think as a team, we thought early on would be a very active tool for Congress to use. But sort of given where we are with COVID stimulus, which is supposed to go to the floor in March, along with an impeachment proceeding in the Senate. And then on top of that, you know, the Congress and the administration hasn't even gotten started on their legislative priorities. So we think CRA usage, it will probably be few and far between. There's been some discussion about perhaps some energy or climate related regulations that could be targeted, that perhaps could not be captured in Biden's reg freeze, which he issued on his first day of office, which essentially could stall or delay or withdraw regulations that were issued prior to President Trump's administration departure. One of the regulations that's been talked about is the DOL ESG rule as a possible CRA candidate. However, there's been many signals from the White House and within the Department of Labor to go ahead and address that on its own without having to use CRA. If you had followed the issue previously last year while it was being deliberated, it was certainly a unique time in Washington where you have industry and consumers on the same side that were not in favor of that rule. So there's probably a lot of energy to make some changes. Finally, you know, I think it's important to keep in mind that we'll continue to see some of these executive orders coming out, but what we're most looking forward to is that transition to legislation. So with that, I'm going to turn us to the next slide. Oh, I apologize.
Sorry,
we're no longer using slides.
You will get the slides though in your inbox afterwards. But on the next topic, which would be the next slide, is our implications for all of you on implications for foreign banks. Overall, we anticipate increased scrutiny and oversight for all banks, regardless if it's big or small. Some of the appointees have already put out some blogs and op-eds and some media interviews signaling that they are looking to go after banks regardless of size. Foreign banks often get captured in that. And we also expect more attention of foreign banks to come from the Senate Banking Committee Chairman Sherrod Brown, and also from the new leadership at the SEC, or possibly incoming leadership at the SEC that Erica will get into. A key issue for FBOs, as you know well, is a lack of understanding of international rules. We've even been, FTI, been working to coordinate our climate council with our colleagues in UK and Brussels, because there is a lack of knowledge here in the US on what you are doing back in your home country, whether it be there, Canada, or elsewhere. And there needs to be education there before rules are written here and the US doesn't go it alone. So that will be an extra challenge that you have as these rules are being implemented. Infrastructure, Biden is planning a large infrastructure bill that we will get into. Maybe some more possibility that it could be achieved in this one. And that will be another opportunity for foreign banks to showcase their footprint. But overall, we also think that foreign banks are in a better position than you may have been 4 years ago, with thanks to all the effort you made on capital and liquidity. So you're in a better position to tell your story. And then overall for the banking industry, it's kind of a mixed outlook. Sorry. It's with Biden, he's campaigned on a return to normal and increased certainty for the markets, which should be a welcome sign for any financial services institution. He's traditionally been more moderate. However, he's very quickly already shown that he has pressures from progressives on appointments, regulation, and enforcement, where some of his cabinet positions have been more moderate, like Janet Yellen, who got widespread support. Some of the people he's named or could be naming to lead up the agencies could be more progressive, and we expect them to be a lot more aggressive from the OCC, SEC, Treasury, a lot more oversight, enforcement on rulemaking. Some of the targets you may already know: climate change, diversity inclusion, overdraft, regulation, fair lending, arbitration, and racial equity will all be key targets for these incoming regulators. And then Erica will talk about your fund agencies of SEC and CFTC.
Thanks, Cheyenne. So as has been telegraphed and talked a lot about in the popular press, at both the SEC and CFTC, not only are we going to see increased rulemaking activity, but we're going to see a lot of increased enforcement actions. And this is a key way that regulatory agencies also often try and expand their jurisdiction. Obviously, you can expand an agency's jurisdiction through rulemaking, but you can also get creative through enforcement to try and delve into new areas. And so we certainly think the SEC, the CFTC, and the Consumer Financial Protection Bureau are going to use enforcement to expand their agency's jurisdictions. Gary Gensler, SEC nominee, he will certainly expand the agency's investor protection efforts. Obviously, he's got his work cut out for him. He hasn't even had his nomination hearing yet. And with the GameStop madness happening in the markets, you already have Democrats on the Hill and some Republicans as well, kind of lining up to say what the SEC's priorities should be. So investor protection is certainly going to be on the top of that. And then Gary's been really active on digital assets as well in his tenure between being CFTC chairman and his nomination to the SEC. So we expect that he will look to expand the agency's purview over digital assets beyond just initial coin offerings and any of right now tokens that look like securities is where the SEC's got to focus. Other areas of focus for the SEC are going to be ESG principles and disclosures, China, direct listings, SPACs, revisiting the best interest regulation, Reg BI, in conjunction with maybe a resurrection of the fiduciary rule over at the Department of Labor. So that is expected to be on the SEC's agenda here at the beginning of the administration. Over at the CFTC, Commissioner Russ Benham has been named as the acting chairman. The scuttlebutt is that Chris Brummer, who is a Georgetown professor, rather prominent in the fintech circles in DC, is the leading contender to be nominated to be chairman. Brummer was nominated as a Democrat commissioner toward the end of the Obama administration, and the Senate didn't manage to get around to his confirmation. So there's quite a bit of discussions about the possibility that he might be nominated as chairman. Market participants can also expect at the CFTC to see climate-related activity happening. Commissioner Benham has been really active on looking at climate-related impacts to the financial system during his tenure as the head of the Market Risk Advisory Committee at the CFTC. He issued a report on this and has been pretty active raising his profile here. So that may be an area where, as acting chairman, he looks to try and have some movement for the agency. And then other areas that we expect to see movement on, potentially the resurrection of Reg AT, which targets algo trading, and among other things, would allow the agency to, without a subpoena, request proprietary trading algorithms from market participants, something that is incredibly controversial in the marketplace, but something that the agency has previously considered. And then most likely considering reversing the cross-border swaps rule that was just finalized this past year, and reinstituting the agency's prior approach under DoddFrank Title VII. That was a big part of the dissent that Commissioner Benham and both Benham and Berkovitz wrote when the agency finalized the cross-border proposal, was that it tacked away from Congress's original intent under Dodd-Frank, and that they should go back to the approach that was created under Gary Gensler's chairmanship of the CFTC. So that's what we're looking for here. I will hand it over to Meredith to talk about climate risk, diversity, and inclusion, or to jump in and give any additional perspective that I may have missed on SEC and CFTC.
No, I think you did a fabulous job on SEC and CFTC. So now we're going to talk a little bit about climate change and ESG efforts. As you're well aware, climate change is a key and central theme for the Biden administration. Last week, a bunch of executive orders were issued, and the questions that we have gotten from clients, both in the U.S. and outside the U.S., is sort of what is the impact on this for financial services. And so throughout that whole package from last week, there wasn't anything that was directly targeted at financial services. Perhaps some indirect implications, as there's going to be a strong approach to focus on renewable energy or green building or green infrastructure, for example. There was one sentence, though, that we wanted to point out to you that said, the White House is extremely committed to seriously take the climate risks to national security and the financial markets. So for us, there were a few things in there that were sort of tied in, such as a task force of 21 regulatory agencies that would be convened by the White House, as well as other councils that will be coming out of the National Economic Council to really look at the impacts of climate change. And we think perhaps there would be a lot of the discussions and possible proposals and movement when it comes to impacting the financial markets. I don't have my crystal ball with me today, so I can't look into it and tell you if perhaps a financial services climate change related executive order is coming, but given the direction of what I've just said, plus what I'm about to tell you now, leads me to think we're going in that direction. Some of the things that we've been following that are very likely, of course, are opportunities for the administration to act on its own at the agency level. Some of those efforts include climate and diversity disclosures from both the SEC and the Fed. We're not going to hypothesize on whether or not they're coordinating, but certainly they both expressed interest in tackling those issues. Additionally, regulators have been encouraged, whether it was from the Senate Democrats put out a report last August talking about how they really want regulators to incorporate climate risk into their supervisory responsibilities. And we know at the state level, this is already happening in New York, who has already initiated such efforts. The Federal Reserve could be directed to stress test financial firms for climate risk. And of course, we've talked about the DOL ESG rule already, but that's certainly another area that seems very likely. Erica touched a little bit on Gary Gensler and what she expects as his priorities. And certainly we expect him to mandate disclosures on climate change and workplace diversity. And a new development over at the SEC as of yesterday was the establishment of a new advisor to the chairman, currently the acting chairwoman at the moment, but certainly for when Gary Gensler gets confirmed, as a new ESG and climate change advisor. So that is certainly a new development, again, showing sort of the direction of the direction the agencies are going and taking climate change initiatives very seriously. So the Federal Reserve has already announced and jump-started its efforts around climate change. They joined some international organizations, had made some public statements, and all of that sort of happened back at the end of 2020. So really before Biden, the Fed was already sort of moving in this direction. And then finally, we expect financial services firms to take social leadership positions on climate risk and diversity and inclusion. And we think that foreign banks are pretty well positioned to serve as global examples. So with that, I will turn it over to our resident tax expert, Kyle.
Awesome. Thank you, Meredith, and good afternoon, everyone. And I'd be remiss if I didn't start with reconciliation, because that's where the tax opportunities and risk are situated right here. And, one thing is clear in reconciliation: you can either increase or decrease mandatory spending, or you can increase and decrease revenues. And it's much easier to increase tax revenues on a permanent basis through reconciliation than it is to cut taxes. I think Janet Yellen, soon to be secretary or now treasurer, in her hearing last week, said that it's probably unlikely that Democrats will pursue revenue increases until they stabilize the economy. I think what that means is it's looking likely that Democrats will use both of their reconciliation options from the previous last year's fiscal budget resolution and then this one. It's probably likely that the latter is where the risk of revenue increases could manifest themselves, and I'm thinking that's probably going to be Q3 or Q4 of the year. As you guys recall, it took Republicans 6 months to try to pass their first reconciliation bill, which amended provisions of the Affordable Care Act. And then it obviously took them till the end of the year to pass TCJA at the end of 2017. So I think these things takes time. They often include a number of authorization committees. And I don't think that the Democrat agenda is going to be centered on tax policy. I think it's going to be more related to climate and how infrastructure fits into the climate debate. And so I see tax as sort of, from an industry perspective, you don't want to be caught potentially as a pay for or part of an offset as, helping the some other agenda, which would include mandatory spending, move along. So I think that's where the risk is. Republicans should be united against tax increases. They historically have been united against tax increases. Except the only time that obviously John Boehner had very minimal leverage on the fiscal cliff back in 2012. And so Obama was able to raise a number of individual tax rates. And so I think that's sort of the procedure that we're going to look at. I think the corporate rate from a financial services industry perspective is probably one of the higher level threats. Traditionally, as you guys are well aware, the industry has not sort of been available to use a lot of the credits and deductions within the code, not capital intensive industry. So a lot of the things that were included in the TCJA, like expensing, back to bonus depreciation, amended R&D credit, that type of stuff, a lot of industry will be willing to have conversations with Congress about the potential of a corporate rate increase. If you look at the capital intensive industries, the industrial industries, the energy industries, they would maybe be okay with moving to a 25, 26, 27% rate if it preserves the things that they get in the code that they fought for, such as expensing, intangible drilling cost for the energy industry. A lot of those industries may be amenable to those negotiations. So that's something to keep an eye on is if Democrats try to raise the corporate rate, it could split the industry. Speaking briefly on the financial transaction tax, which has been more of a hot button topic from a narrative perspective and a campaign perspective, I think Senator Wyden and the Finance Committee have made it very clear that they want to prioritize his mark-to-market proposal of taxation, which basically ends the deferral regime of capital gains and would mark-to-market taxation of unrealized gain or loss on an annual basis. And I bring this up for a couple of reasons. I think that an FTT and a mark-to-market are two different policies. In a way, they sort of they duplicate and overlap each other. You're going at how you tax the treatment of market activity or capital gain activity. And I don't think that the Senate Finance Committee is going to have the bandwidth to take both of those on, particularly given the sense that they would like to also take a look at the international regime that was created in the TCJA Act of 2017, obviously. So I view an FTT, as long as Wyden is trying to move his mark-to-market plan forward, I view an FTT as something that may not get a lot of traction on the Hill. It traditionally has gotten a lot of support among the progressive community. So one thing that we need to be looking out for is, does it gain more mainstream traction in center-left think tanks or media publications or something like that? The other thing to look at would be, obviously, Bernie Sanders is going to chair the Budget Committee. The Budget Committee is the vehicle for reconciliation, although the authorizing committees are much more powerful than the Budget Committee. So he has supported some type of FTT in the past. It remains to be seen if that's something that he takes a look at or wants to push for. On GILTI, on global intangible low tax income, I think Wyden's staff publicly made comments recently that they will look at the international tax regime and look to propose changes. His staff at the Finance Committee just said they'll likely release a policy document soon that outlines an international tax framework and proposals that they would like to advance. And he has stated that this document will be consistent with Biden's tax agenda. Obviously, Biden proposed a doubling of the GILTI tax rate, and his tax proposals leave a lot of detail to be filled in. But I anticipate proposed changes to GILTI from a Wyden-led Senate Finance Committee. Whether or not that's able to get through reconciliation from a political perspective, who knows, but it will likely include increased in proposed revenue, which would obviously be doable under reconciliation. And again, the last thing I'll touch on is BEAT. And there are folks on the Democratic side that believe that the exemption for BEAT, which is at $500 million, is too high. It's possible that Democrats could look into lowering that exemption. The other thing that would be easiest for them to do would be basically to just increase the rate. The BEAT rate is scheduled to go up to, I believe, 12.5% in 2025. Democrats will be able to sort of turn that dial either closer into the budget window in the next couple of years and raise that rate if they wanted to. So that's another thing to look at. I continue to think that it will be difficult for Democrats to do a wholesale regime change of TCJA, particularly on the international side, but it will be easy for them to dial up certain provisions in TCJA in order to raise revenue. And at the end of the day, when you're dealing with reconciliation, it becomes a math exercise at the end of the day and less of a policy exercise. And so you're trying to make the pieces of the puzzle fit together. And I believe that's where most of the risk is going to come in on the tax side, because you don't have to go through the process of trying to create a new regime, amend certain laws, make up new proposals. You can just dial things the way that you would like to dial them. If their priority is climate or infrastructure, I think that's where they're going to look to be aggressive on the policy front, and they'll at the end of the day, the quickest and path of least resistance is to just make nuanced changes to some of these new provisions in the code in order to raise the money that you'll need to raise.
And Kyle, we have a question in the chat that I know you'll be thrilled to opine on. Any thoughts on long-term capital gains tax increase that Biden has talked about, and how likely is that to happen?
Yeah, I think that the Biden administration is probably going to give way to Wyden's mark-to-market proposal. And the whole point of that proposal is he believes, and his committee staff believes, that wages should be taxed in the same manner as wealth. So wages are taxed as ordinary income. Biden believes, or excuse me, Senator Wyden believes that certain capital gains income of high net worth individuals should also be taxed as ordinary income. And I think that until we hear otherwise from, for example, the Treasury Department, which we don't know who the Assistant Secretary of Office of Tax Policy is going to be, so they have not opined their viewpoints on capital gains. The proposal that is most out there right now is Wyden's desire to, number one, end deferral of capital gains, but also move some of the rates of that taxation from the preferential cap gains rates to ordinary income, which is extremely problematic for a number of folks on this call in this industry, and a number of the products that the customers of this industry buy. So it's a very real threat. Unclear if it's going to gain a lot of traction. It's a serious proposal. It's a complicated proposal, and but that's one way that Democrats think that they have the political high ground.
Thanks, Kyle. Appreciate it.
And, you know, before we move on to talk about international cooperation, we do have one more question. Kyle, you're quite the popular speaker. We actually have two more. Any view on repeal of the SALT deduction cap? This is a question near and dear to Meredith's heart, just so you all know.
I don't think that there is widespread bipartisan support to do that. The other thing is that is a huge revenue loser. So Democrats could pursue that in reconciliation, but given the fact that it loses revenue, the reconciliation rules would make it difficult for that provision to be permanent. So if that debate manifests itself where Democrats are able to peel off enough Republicans to entertain that, or they decide to include that in a reconciliation bill, what is most likely is going to be a delay of that, or a temporary reprieve of that. It's going to be extremely difficult to get rid of that on a bipartisan basis. And Republicans will probably really latch on to the fact that it helps higher income earners in high taxed states, which we all know which ones those are. And so I think to the extent that Democrats push that, they'd probably be looking for a temporary repeal or delay of some sort.
Nice. Thanks, Kyle. So that we will move on and talk about international cooperation and tensions. As many of you've seen, President Biden has already begun working to reestablish and repair relationships with allies and re-engage with the international community, ending the isolationist policy that was kind of advanced during the Trump administration. The Biden administration has the U.S. rejoining a lot of multinational fora that they had left during the Trump administration, or looking to re-engage seriously in those various fora. One thing that I do think is important to note is the Biden administration is bringing back a lot of people who have significant diplomatic experience to serve in senior roles in this administration, and there's still a lot of career staff involved. And so you'll have kind of this posture that is more deferential and diplomatic in the re-engagement in international bodies. I think that there is a realization that the U.S. stepped away from the table at a lot of these, and so it's less likely that you'll see the U.S. coming back to the table like a bull in a china shop, and more like in a more deferential mode, understanding that as the U.S. stepped away, there were a lot of parties that were still at the table doing the work, and the US really doesn't have a platform to come in and start calling the shots and dictating how things should run, given our absence from the policy conversations over the last 4 years or so. In terms of international policy, obviously, any trade deals that are emerging in the wake of Brexit could present complications for FBOs operating here in the US. The EU-China agreement has the potential to create challenges here in the US for FBO US operations. And the administration is going to continue, the Biden administration is going to continue taking a strong stance on China. Clearly, the rhetoric is not going to be the same as it was during the Trump administration, but one of the few areas of bipartisan agreement during the Trump administration was a lot of those pieces of legislation that was aimed at China or aimed at sanctioning companies who were associated or enabling mainland China's targeting of Hong Kong. That was bipartisan. Republicans and Democrats came together on a lot of those bills. So this administration will be maintaining a lot of those policy stances. Again, the rhetoric is not going to be nearly as hot-tempered as it was during the Trump administration, but the policy is probably not going to change. President Trump signed legislation in December to bar Chinese companies from listing shares on US exchanges or otherwise raising money from American investors if they refuse to allow US auditors access to company records. We don't anticipate that is going away. The Biden administration's Office of Foreign Asset Controls, however, did extend the deadline until May 27th for the Trump administration ban on American investors, pension funds, and financial firms investing in companies that have similar names to a group of blacklisted Chinese firms that have ties to the Chinese military. So that is one area that the Office of Foreign Assets Control has given a little bit of flexibility on. And one thing we saw during the Trump administration was that the executive branch really did kind of activate OFAC as an arm of the White House to be rather punitive in this China crusade that Trump was on. A lot of 5 p.m. Friday news coming out of OFAC. We really expect during the Biden administration that it's going to go back to a little bit more business as usual, kind of more deference to the career civil servants over political appointees within Treasury or over at the White House dictating to OFAC what they should be doing. So that's probably good news for a lot of people on this call. And then we do expect that scrutiny of foreign investments in US tech through CFIUS will continue under Biden, although again, Biden is certainly going to bring more certainty to that process and frankly, a bigger sense of process to CFIUS. So with that, I will toss it over to Sanjay to talk us through mergers and the rise of fintech.
I appreciate that, Erica. Thank you. Mergers in financial services have already begun, but mergers in the Biden administration will face heightened scrutiny. PNC, BBVA will be a litmus test as super regionals are at a pivot point on mergers while at risk of a higher profile. Another example, Federal Reserve Governor Brainard has been a dissenting vote on key mergers as she voted against TD Ameritrade in the Schwab merger. We've seen under COVID and directionally under the new administration, we're going to see a continued regulatory scrutiny on areas such as anti-money laundering, fraud, cybersecurity, vendor management. When I talk about vendor management, it's really third party and fourth party. and governance, to name a few, and specifically for FBOs. Banks of all sizes are facing competition on innovation by fintech companies and non-bank online lenders. These online institutions are enhancing their relationship with banks, as we expect to see an increase of joint ventures, mergers, and acquisitions under the current environment and administration. The fintech charter and regulation debate will continue under the new administration, and specifically appointees. While we are bearish on the continuation of previous acting controller Brian Brooks, his bolder fintech positions, fintech policies tend to cross party lines and will continue, though a more cautious pace. Biden administration has floated Michael Barr to serve as comptroller of the currency, but some believe he may not be progressive enough. Progressive groups have also mentioned Mirza Biradran, who is more progressive. The next chair will make decisions about the future of cryptocurrency firms and fintechs that are seeking charters for more traditional banking functions. New banking platforms and associated forms of fintech are focusing on new regulatory decisions. Now, the OCC will be taking the lead role on all of these decisions. The incoming CFPB's agenda items will include open banking, AI underwriting, payday lending, student debt crisis, amongst things. Rohit Chopra was named to lead the bureau and comes in from the FTC. This will boost confidence from the progressive leaders who've been pushing Biden to act swiftly and ambitiously in this area. Online broker-dealers will be under scrutiny and operational compliance issues, as this has been a main topic of discussion across the aisle, and Erica brought it up earlier as well, what's happened over the past week or so in this area. In another major area, central bank digital currency is gaining momentum in countries like the Bahamas, where they're starting to put out a central currency. In the US, the impending launches from private sector projects like Libra have driven the US to rapidly mobilize efforts in the central bank digital currency space through private and public coordination. The Federal Reserve has also expanded research through direct engagement with technical collaboration with MIT on this. In addition, one of the items that Erica mentioned earlier as well, Gary Gensler, definitely comes from a background and has recognized that blockchain will be a change catalyst in the upcoming years. But I'll turn it over to Cheyenne to discuss now the infrastructure ambitions.
Thank you, Sanjay. So we'll talk infrastructure, and then I know some of you are going to have questions on nominees and the appointees coming in. So we'll touch on that and then welcome up for some broader questions. Infrastructure, I think this is an area that FBOs can shine. This is your opportunity to tell your story. You already know you make great investments in infrastructure in the US and have a great story to tell. The Biden administration has outlined a $2 trillion infrastructure plan. Well, the skeptic, any of us that are in DC are skeptics, so can say that haven't past presidents already tried infrastructure bills? Isn't every week infrastructure week? We'll try to be a little positive. Now Treasury the Transportation Secretary, who was just confirmed today, 87-13, said he is confident there's bipartisan support. And areas that we could be positive on the possibility of infrastructure is the need to create jobs. Infrastructure can be a way for COVID recovery. And in that way, there could be partnerships with the Biden administration or with cities to expand on your infrastructure narrative and infrastructure work. But as you know, a theme in Biden's infrastructure plan is climate and sustainable infrastructure. So infrastructure that leans on to sustainable investments, sustainable infrastructure, green infrastructure, that will have a better chance going in this administration and a better way to kind of tell that story. So now we can go and talk nominees, and then we can take some overall other questions.
Great. And Caroline, could you throw that nomination slide up for everybody to see? Thank you so much. So We've put together a list of the top regulators we thought you would most be interested in, and underneath all of their seals and logos, we've identified who's been confirmed, who's been announced, who's going to be acting, and perhaps who's going to be rumored to lead the agency. In the interest of time, I'll turn it over to Cheyenne to touch on a couple of the more critical banking regulators. But before she does that, we do have a couple questions that are great for Cheyenne to ask that are also relevant to the slide. So the first one is involving the Federal Reserve and Randy Quarles with an expiring term in 2021. And the question is, who could be a replacement for Quarles as a VC of Supervision and Regulation? And are you aware of any contenders and what their key priorities might be?
Thank you. I won't opine on possible contenders because, as our public affairs leader, Jay Dunn, tells me, that's a way to get into some pitfalls here in politics. But I will say, if you look at where the administration is going on some of their cabinet or their agency appointments, it may be an untraditional pick and a little more progressive. As we said at the beginning, Yellen is more moderate, brings a more international cooperative philosophy to the role, probably is going to beef up coordination through FSOC. Their agency picks at both the federal or at the OCC, CFPB, SEC are tending to be more progressive. So especially after Barr and Gensler were announced, a lot of my lobbyist and lawyer friends said, wow, what does this mean for Randy Quarles? And we are probably not going to get maybe the traditional bank lawyer in whoever they do pick. So I don't know who it is, but it's probably not going to be cut from the same mold that we usually get there. Other areas, as we mentioned, Rohit Chopra coming from FTC, going to be very active. Even the acting director, though, issued a blog post last week saying we are going to get back to enforcement, and even outlined a lot of egregious behavior he has noticed recently, even kind of related to PPP. Gensler, as we have said, we expect him to be very active. We know he's already staffing up the staff, as we've heard from some of us that work at FTI, that he is very energized to get active on climate. OCC, many of you may know Michael Barr from his time at the Treasury Department under Geithner. He ushered in pushed a lot of the consumer finance portions of DoddFrank. He's gotten a little bit of criticism on some of his roles in some other parts, but I find him very progressive. And it's interesting, though, if he is going to be attacked for not being progressive enough, I think that shows what Biden is facing on these nominees.
And Cheyenne, can I quickly ask you a question about the OCC? We have a question about the OCC fair access regulation that was withdrawn last week, and just if you have any thoughts on that regulation.
It seems like that regulation, it was met with widespread opposition. I do not see that regulation going forward. As much as banks, I think, talking to a bank lobbyist right before this, they don't want to be told what they should be invested in or what they shouldn't be invested in. So I do not see that regulation being implemented. It comes within the reg freeze. It's already, I think, in danger. It was issued on the last day, I think, that that Brooks was there. So I think we are a bit safe on that one. And then before we go to the prudential regulators that, or the non-prudential regulators that Erica and Meredith know better, FDIC Yelena McWilliams is staying to, or has said she would stay to fill out her term. Her term ends in 2023. However, the interesting thing is on the FDIC 5-member board, it has to be a majority of the president's party. So that is going to be difficult for her to kind of push things forward that may not be aligned well with the administration. One thing that they are working on is another CRA, the Community Reinvestment Act. So that could play into how that plays out at the FDIC and among the prudential regulators. And I don't know if it's also hidden by our screens. We also have Department of Labor, FHFA, and CFTC on here, but you will get these names when you get the deck. Erica or Meredith, do you have any others, or we can kind of open it up to broader questions?
Yeah, I think we can wrap this up, and I know there's a few more questions to get to, so I'll turn it over to Erica.
Sure. Well, so I would just broadly say, Caroline, if you can advance to the last slide, we can wrap up the slide presentation. And just say broadly, obviously, our perspective on financial services, public affairs, is that politics is no longer constrained by the beltways of capital cities. We've seen this here in the U.S. You've seen it across many other jurisdictions. The rapidly changing environment in politics, it poses operational, reputational, regulatory, and legislative risks to financial institutions. We have lots of resources and lots of teams that help clients think through how to respond, how to anticipate, and how to manage these risks. So we are always more than happy to be a resource for any of you. So with that, Caroline, if you would just take down the presentation, I think we've got a couple more questions already queued up in the chat that we can get through. The first being, I think Kyle is chomping at the bit to talk about derivatives and mark-to-market. So Kyle, if you will jump in there and answer what you told me was a very simple question.
Yeah, well, so the taxation of derivatives is not a simple application, but I can give a very simple answer to that question without knowing exactly what it's going to look like. In Senator Wyden's discussion draft, he noted that it is his goal to require mark-to-market and ordinary tax treatment of all derivatives and all derivative transactions. So they very much will be a big part of how he plans to advance this proposal.
Thanks, Kyle. We do have another tax question for you to opine on. How do you view the recent appointment of Kimberly Klossing as Deputy Assistant Secretary for Tax at Treasury and her focus on taxing of multinationals? Is there any possible influence on tax reforms?
Yeah, I mean, I think that one's a little bit more up in the air. She's obviously been very critical of the international tax structure and regimes that we have both in the U.S. and around the globe as it pertains to multinationals. We don't yet have a nominee for her boss, and the rumors have been swirling that it's going to be Lily Batchelder, who is a former Wyden chief tax counsel at the Senate Finance Committee, also did a stint in the Obama administration and has testified numerous times in front of Congress. She's currently a law professor at NYU, I think. I think where they're going to have to decide where they want to spend their time on is do they want to open back up the formal rulemaking process related to some of these regulations from TCJA? I mean, it took the BEAT regulations took 2.5 years to get finalized. The GILTI regulations took years to get finalized. It just remains to be seen if they actually want to be more aggressive on that front, because that would take a lot of time. I think what is going to be more interesting is how they position themselves at the OECD in terms of Pillar 1 and Pillar 2 on that front. Obviously, digital taxation was a huge debate that led to an impasse between the Treasury Department and numerous EU countries. So those negotiations stalled. And so I think we could see a differing of posture at the Treasury Department in terms of trying to get to a more unified framework on some of these issues that are being debated at the OECD right now. I think what is a little bit more unclear is, do they actually want to take the time to restart like a formal review of rulemaking related to a lot of these TCJA provisions that were highly litigated during the regulatory debate, and industry weighed in, and they took a long time. So I just don't know if that's going to be somewhere where they want to spend their space, right off the bat.
Thanks, Kyle. Cheyenne, we have another question for you about the Fed. Fed Governor Brainard has been rumored as a contender for the Vice Chair of Supervision and Regulation. Any thoughts on that?
So, as much as I said I wouldn't opine on possible nominations, I guess I have, because in my research for this, I did reach out to, I think, several people, a lot of people brought up, we're even starting to call her already Vice Chair, Lel Brainard. So I don't know how possible that is, but it does seem like it's a strong contender there. One thing that they all brought it up in context, that if she does take that role, is the Fed liquidity rule for branches that was originally considered as part of the, the 2017, 18, or 19, those years meld together on the Fed's tailoring rules, that will likely come up again. So that's something to watch out for if she does become the nominee.
Thanks, Cheyenne. And Erica, I have a question for you, a little bit of comedy in this one. As bad as the situation was during the last financial crisis, a new regulation every 2 hours and 10 minutes, there was a finality to those reg changes. This time, there's a lot of complications coming from the states and from executive orders. How do you see the regulatory environment shaping up in the coming days? More final laws, more executive orders and state regulations?
I think that's a great question. And I think back to my time on the Hill during the 2008 financial crisis. I was working as staff on the House Financial Services Committee, and you had Barney Frank as chairman of the committee. It doesn't matter what party affiliation you are, you have to marvel at his brilliance and control as he led the committee through a very deliberative process that ultimately became DoddFrank. And then in terms of the reg implication, this is a good parallel to call out, because Gensler at the SEC was really pushing at the CFTC, was pushing CFTC staff into overdrive, raising the agency's profile, expanding the agency's jurisdiction, and putting out regs approximately every 2 hours and 10 minutes to that point. So that was a much more deliberative and frankly transparent process at the very beginning, as chaotic as the rule writing process was at the end at the CFTC. SEC still has some work to do on Dodd-Frank implementation, by the way. But I do think, unfortunately, you don't have that kind of centralized deliberative control coming from Capitol Hill in terms of issuing legislation with direction for regulators to implement. You have state regulators that are starting to be incredibly active on all sorts of areas, whether it is fintech, consumer protection, data privacy, et cetera. So I do think, unfortunately, we're probably going to see more of a patchwork approach. Gary Gensler being very active at the SEC, Rohit Chopra very active at the CFPB. I don't think we'll see as many executive orders out of this administration in the way that you saw them out of the Trump administration. Executive orders seem to blindside everybody, including like people working in the administration. I think they'll certainly be a little more thoughtful this time out of a Biden administration, but I do think that both the pace is going to be a little bit more frenetic, and it's going to be not quite as cohesive as it was in the Dodd-Frank response to the financial crisis. But great question.
I think we have others, but I think it may be almost time for us to wrap up. So we could we can compile these questions, follow up with any responses, and send our responses to Megan and Bridget. If you have any others, they can also connect you to us. But we just want to thank everyone for their very active participation. It's been a very lively discussion. Definitely glad Kyle's here to take any tax questions, so I don't have to. We've made that mistake in the past. But thank you so much for Bridget and Megan for allowing us this opportunity. You have a very lively, active group, and it must be fun doing these webinars often with them with this activity.
Everything at the IIB is fun. Thank you so much for being here today, and thank you for really targeting the presentation to our FBO issues. That's really, really appreciated. You know, one bad thing about being the this is webinar host, is that I can't submit questions. So I have a bunch for follow-up too that maybe we can share with the group. Again, it's so great to be able to take advantage of this kind of expertise. So thank you. Keep in touch. It doesn't have to be a webinar for you all to flag things that we should be paying attention to. And we look forward to continuing to work together. I know you all are really busy and we're beneficiaries of that. So thanks.
Thank you.
Thank you.